Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 276th VideoCast podcast for the week ending January 30th, 2025. As always, we're going to start with family first, then we'll get right down to business. Got a lot of incredible data to cover today, although when everything's going right, there's really not a lot to say. As you know, we like to spend time on the names that are just leaving the station versus doing victory laps for the ones that are soaring, and candidly, there are a lot more soaring today than just starting out of the gate, which is pretty exciting to see, and nicely coming for those of you who have been listening for a while and reaped some significant benefits, and certainly clients very, very happy these days. So excited for that. This is Annabelle. You want to speak of real accomplishment. Annabelle was in Las Vegas this weekend for the Southern California Swimming All-Star Festival. She got first place in all 6 of her individual events and set 5 meet records in the 200 free, 50 free, 100 back, 50 fly, and 200 medley relay. Afterwards, Caitlin and Annabelle hit the town and took in the sights. So that was Annabelle with the Las Vegas sign. I stayed back to take Mimi to the daddy-daughter dance at our club, and that was just special, trying to squeeze the last few bits of them being young daughters at 12. We're pushing up against the limits here for daddy-daughter dances, so I was excited to do that and get her to her activities here in Orange County. This was this photo here, and then there's some more of Annabelle. I guess that's the Luxor. Wow. This was amazing. Want to thank Brad S. for hosting me at Mission Viejo Country Club this week. It was called a Monster Pin Scramble, and we tied for 5th, 6th, and 7th, all had net 74. We were ham and egging it all day long, dropping some putts. This is historically a course that is impossible to putt, and then they put the pins in the most difficult possible places ever. But we pulled through. So kudos, really hats off. Had an incredible time with Brad, and the fact that we could compete and come in basically tied for 5th, and then there were other 5th, 6th, and 7th was all the same score. That's more of Caitlin with Annabelle that's Paris in the background. Pretty cool stuff. There's Annabelle doing some Elvis impersonations. And this was interesting. She took a picture randomly in front of the Chinese Year of the Snake. So maybe, certainly I would say that podcast we did with Brendan Ahern of K-Web last fall after I played golf at his awesome course in Connecticut probably marked the bottom of Baba. And, now everyone's getting excited about it, but the Year of the Snake, and there she is randomly. There are no accidents. That's pretty cool. And then a friend and client sent over this hat he made up called hashtag TRT, Turnaround Tom. Gosh, did he already trademark that? Yeah, well, now you know my clients. All these centimillionaires, a couple billionaires, and decamillionaires many times over. They're ahead of the game on all of it. But it says, burden yourself with the facts, hashtag TRT. Pretty cool stuff. Okay, by the way, just as a last point, I think last week I shared how embarrassing my golfing had been since moving out here after being on break. Well, it's grooving now, and shot my best score ever in history Saturday, which was an 80. Even, so I still have not broken 80, but I really thought that was so far off the way I came out here and started playing. It was a disaster, and I actually am starting to gain confidence that it's durable, and I can hear all the golfers laughing in the background. But I got this device, and again, wait for the chuckles, called the Hack Motion, and I have no affiliation with the company. And it just basically measures your flexion and extension at the top of the swing and impact wrist angles. And you basically, for those of you who don't know golf, you want to be more bowed at impact versus extended, bowed like this. And it just does that. And I've been grooving that, and it's been a complete game changer. Obviously, I can putt now with my long putter that everyone laughs at, putt pretty well. And so now I think better out of the sand. I think I got to work on some chipping, but complete game changer. So I thought it would be fluky. It's not feeling fluky at all because I continue to just grind in the data, and I just look at flexion and extension. When I'm in flexion, I just pure the ball. And so I'm going to work on that, and pretty excited because for those of you who've been following, you know my goal for 2024 was to get to a single-digit handicap. I failed, but I didn't quit. I almost quit the game. Seriously, when I came out here after moving and not playing for 4 months, I was embarrassingly bad. It was like, a friend was out, and I said to him, I was like, I was better 2 years ago when I was just starting. And he's like, yeah, you were. And literally that day, it's, hack motion thing comes up on my Instagram. I fall for it like a sucker, and it actually works. So there you go. All right, on to business. Want to thank Camille Smith, Claire Phelan, and Mary Calvi for having me on CBS to discuss the Fed this week. We're going to listen in here.
Service meeting for the first time in 2025. Economists and consumers alike are waiting to see if and when there will be more rate cuts. Joining us now is Thomas Hayes, chairman and managing member at Great Hill Capital. Welcome.
Thanks for having me, Mary.
And President Trump has called for interest rates to drop immediately. Do you predict any shakeups or surprises, or will it be business as usual?
I think the secret to happiness is low expectations, and we can expect business as usual. Right now, there's a 2.7% chance or expectations that there will be a cut for this meeting. So very low expectations here. I don't think that will change even if Trump wants cuts immediately because, number one, they have to get more information. Tariffs and deportation could be short-term inflationary for prices. The DOGE, Department of Governmental Efficiency, could offset some of that, but they can't make any decisions until they know what the landscape is going to look like.
How do you predict the central bank's relationship with the new administration will be?
Probably less pleasant than we've seen in recent history. Trump wants rates lower. He's going to continue to pound on that table. And Jay Powell is going to continue to ride out his term to early next year and do exactly what he believes the data is telling him to do. So expect a lot of push and pull there. President Trump does believe he should have a say in rates. The Fed is an independent body, so I think that will be the push-pull moving forward. And there's limitations on what can be done to really force the Fed's hand.
Many are saying inflation concerns have eased, but plenty of Americans still feeling the impact. Do you think the U.S. will hit the 2% inflation target this year, or is it still out of reach?
I think that is unlikely. We do have debt to GDP near record highs, 120% going back all the way to post-World War II. And honestly, the only way to solve for that is you have to run growth above trend, which means inflation is probably going to be in the 2.5% to 3.5% range for the foreseeable future. That's going to help us bring down the debt to GDP ratio through growth. And the good news is wages are slowly catching up. So it should be a push-pull, fast growth, wages starting to catch up, but inflation a little bit above trend.
The Fed lowered rates 3 times in 2024. What is your prediction for 2025?
I think I'm going to side with the Fed here. Their summary of economic projections, their dot plot indicates they want to get 2 cuts in 2025. I think that's realistic expectations. If you look at Fed fund futures, where this stuff is gamed out, you have a 30% cut, a chance of a cut in May. By June, you go to 74%, and by December, you've got a 90% chance of a cut and a 62% chance of 2 cuts by December. I think it's going to be back half loaded. I think we get 2 more cuts, Mary.
Thomas Hayes, chairman and managing member of Great Hill Capital. Thanks so much for joining us.
Thanks for having me.
And we're back. And then quotes of the week. This is an interesting quote, and the reason I bring it up from John Templeton, obviously he was a legend. Markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. And people often equate this, and they always want to do things all or nothing, and it always has to be a macro call. But I can tell you across the board how many things right now feel like they match this, meaning they are in maximum optimism and the best time to sell. And you saw some of that we've been warning you about for some time. And on the flip side, there's a whole nother 75% of the world and different sectors and companies which we're in that are starting to absolutely fly like nobody's business. And I told you it was coming. And by the way, kudos to all the people that came in Q1. I mean, these guys are smiling so wide they could eat a banana sideways, as well as my existing clients are super duper, we're off to a great start. And for 2025. Also want to, it's pretty cool living out here because had a chance to meet one of those new folks that came in. Want to thank Brad K for meeting up in person, and Tom B, I'm going to go meet you. The interesting thing is, we all live, I live a few blocks from the water. I can see it. I can walk from it. These guys live right on the water. They could stick their toes in the sand when they wake up, which is pretty awesome. So I'm going to go down and see you and everyone else around the country. Very grateful, very exciting. And this is what we've been waiting for, and this is what we've laid the foundation for. And it's not about predicting anything. It's about using a durable, sustainable framework that is repeatable over time. And it's the kind of framework, outperformance comes in clumps. It doesn't come linearly. When it comes all at once. And here we are. And kudos to those of you who took advantage of that message this quarter. And I think we're just at the beginning of very, very exciting and good things ahead. So the key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. This is the key thing. This is Warren Buffett. And what he's basically saying here is, in English, you're not going to make money predicting the future. And everyone, that's what they do. They spend their time trying to predict the future. Who's going to be the leader in AI chips? Who's going to be this and that? And Buffett became the wealthiest investor in history through buying durable companies that worked through cycles when they were temporarily impaired. Regular everyday items. You don't need the 100 baggers, over time, because when you're reaching for the 100 baggers, you fall prey to Buffett's number one rule. Rule number one is don't lose money. Rule number two is don't forget rule number one. So yeah, they write books about the lucky gamblers who get it right and make 1,000 bagger on one lucky pick. But I'm telling you, I've been around long enough. All of those people give it back to the casino sooner or later. And, even many of the people who got the subprime crisis correct and everything else, the follow-up acts are few and far between. There are some, but you want a maintainable, durable. It looks a little slower out of the gate, but over the long term, the effects of compounding. I mean, one example that I've shared with you guys many times, but there are a lot of new viewers, so I want to go into it, is Charlie Munger bought this company called BYD in 2009. And maybe I'll even pull it up. By the way, 10-year yield is going down, but BYDDY. So basically, he had the fundamentals right. He bought in 2009. It shot up. Then it collapsed 90%. They held on to it. Buffett wasn't crazy about it, but Munger was, all full tilt on it. And it did basically nothing from 2009 to 2020. So they were effectively flat. They had a 90% drawdown. They had a 70% drawdown, a 60% drawdown over that 10 years. And it looks easy on this chart. If you were living through that, you'd be like, oh, I'm wrong. If you're early, you're wrong, blah, blah, blah. And what wound up happening was when it comes all at once. When your analysis is correct, it did a 10-bagger the next 12 months. So basically in 13 years, they had, call it a 20 bagger. And if you do the IRR on that, it works. And this is an extreme example, but another one I've shared with you guys was we bought Range Resources in 2018 at 11, down from 90. We estimated the fair value of proved and unproved was about $60 a share. They only report 10-year PV10, which is like 20. And so we bought it at 11. It immediately went to 18. We thought we were geniuses. Then COVID came, shot down to $1.60. We loaded the back of the truck like nobody's business, brought our basis down to $4.10. And today it's 40 plus and probably going to 60. So, in the short term looked like a failure, but when you know what you own and you've done proper analysis, good things happen, and so this will probably wind up being a 15 bagger in 7 years. So, do the IRRs on that. But most people wouldn't have sat through it because they trade price, they don't trade value, they don't know how to analyze the business, they don't have the experience. And that's what we try to impart on these weekly podcasts. So, final quote is from Charlie Munger. The world is full of foolish gamblers. They will not do as well as the patient investors. And we're going to find that over and over and over. All the folks who are chasing the shiny objects got a little taste of what it is to be shellacked this week. They will continue to get reminders about that. And if you learn and follow a sensible framework and take the time and be patient and go through the process and get experience, you will not fall for those traps that so many people and so many super intelligent people. I mean, these are not... It's, people say, oh, the retail investor. I'm telling you, billionaires who have built unbelievable businesses fall for the same traps that retail investors fall for. It's just human nature to get sucked into FOMO. I always joke I didn't get the FOMO gene. It's true. And I encourage you to just when you're buying a business because the price is going up and because it's in the news all the time, what I want you to do is pull out the income statement, the balance sheet, the cash flow statement, and analyze what you are getting in terms of free cash flow. And if you had access to unlimited capital, JP Morgan was going to finance you for the whole business. The only catch is you have to put up 100% of your net worth alongside. So let's say you're going to buy a $100 billion business and you're worth $30 million, JP Morgan would put up the rest, but you have to put up the full 30 million. And if you're wrong and you're going to take the business private and you're going to live off the cash flow for the rest of your life, if you're wrong, you lose your full $30 million. JP Morgan will be debt. They'll take over the business. You'll get wiped out on your equity. They'll liquidate the assets, etc. If you wouldn't be willing to put 100% of your net worth to take the business private, coupled by JP Morgan debt, why are you buying it just because the quote-unquote stock price is going up? The idea of buying any instrument on the basis of it's going to go up because more people are going to buy it versus it's going to go up because its intrinsic value is going to go up is a trap that will hurt you royally over time. So that's kind of the crux of what we do here every week, and I think a lot of you have caught on to the philosophy and are smiling a lot lately. So this is something that no one else was paying attention to, kind of a diversion. Everyone was focused on DeepSeek disrupting the AI market this week, and it's certainly true that that's part of it. But what they weren't focused on was the fact that Bank of Japan raised rates to their highest level in many years. So they increased rates by 25 basis points. And what this is, as I've been warning, that very few people have been talking about that don't listen to this podcast or follow me, is that a bigger risk to the Magnificent Seven trade than overspending on chips without a return on investment or overvaluation or any of that is actually the unwind of the carry trade, where people have been getting free money and they've been parking it in the Mag 7 in the US and benefiting from the currency differential and benefiting from basically free money is what it's been. So as that money becomes less free, what you're seeing is an unwind of the most crowded trade in the world, probably in history. And I think we're going to see more and more of that, and it will be in fits and starts like they tried in August, and they got shellacked, and the Bank of Japan governor had to walk it back. This time, they blamed it on DeepSeek, which is certainly part of the formula. If you remember, I was on Varney, and I said, Icarus is flying too close to the sun. The good news is his wings aren't melting yet, and I was referring to Jensen Huang, and I emphatically said, but competition is coming, you just wait. You don't need to be much older than 40, 45 to understand how the semiconductor cycle works. And the problem is you have so many people managing money that haven't been through these cycles and don't realize that just like the GLP-1s, which we warned about, which now has unbelievable competition from all different sides, and the stocks have come off the boil, certainly doing everything that they promise. It's getting people skinny, healthy for the time being, a lot of health benefits, but now there are tons of entrants, so the pie is getting cut up. Same thing's going to happen with the chips. Same thing's going to happen with AI, and we're seeing that over and over. So, speaking of competition in AI, we had Alibaba come out and publish their data that showed that they outperform DeepSeek and OpenAI pretty much across the board. So right now, the Qwen 2.5 Max is probably the best AI the world has to offer. And we've been ahead of the curve on that for many, many months, telling you that there is an AI ETF in China with ticker BABA, B-A-B-A. And part of that premise was, yes, they were developing their own internal stuff. They're number one in cloud. They're going to get all the bulk of the compute demand and all the other things that were part of our initial premise. Furthermore, they've been giving tokens for compute power to pretty much every AI startup in China in exchange for equity. So beyond their own development, you win so many different ways. And that's what's been so amazing about Alibaba. But they've actually, it's not just coming from the startups that they have equity investments in that we have as owners of Alibaba, but it's coming from their own internal development. And now, as it stands, and this is early days, there's going to be a lot of competition, but Alibaba is a major player, and by the data, they are best in class, better than OpenAI, better than DeepSeek on all of these metrics, and I think probably going to continue to be better. Here's a lady who put out a post, and she specializes in AI. Goodbye ChatGPT. Alibaba just dropped Qwen 2.5 Max, and the world is already blown away by its potential. 13 wild examples so far. Don't miss the fifth one. So she's comparing ChatGPT to Qwen 2.5 and showing how it beats it in every single area. Artifacts like Claude, it can code, write text, search the web. Comparison between Qwen video generation and Sora. So you can see here the big difference. It's day and night. Then Qwen 2.5 VL lets you create OpenAI operator-like agent for computer and mobile phones. 3 bouncing yellow balls within a sphere. It can compete directly with OpenAI operator in computer use. Create videos quicker than other AI tools. I mean, look at the quality of these videos. It's unbelievable. Upload files to analyze PDFs, read images, and extract insights instantly. This is huge. Generate uncensored images. This one, if you're not watching, it's a picture of Donald Trump having coffee with Kamala, which is definitely AI generated. I have not seen that happen in real life. I don't think we will be seeing that anytime soon. Qwen 2.5 performs competitively with top models, surpassing DeepSeek V3 in benchmarks like Arena Hard, Live Bench, Live Code Bench, and GPQA Diamond. You can see the data here. Is out with its latest code artifacts. The open source series is under Apache 2.0 and uses Gradio 5 and custom components. So we've talked about in past podcasts moving from training the large language models, which is the capital intensive, to inference phase, which is lower cost. DeepSeek made a claim that what it costs some of the hyperscalers billions to do, they were able to do for 100 billion, they were able to do for 5 million, or a fraction of the cost. It's a game changing. Competition is coming. I think Alibaba is going to be the core beneficiary in the East, and we'll see who's going to be in the West, but this is mind-boggling. And if you see in the US, the number one download is DeepSeek. So the Americans, if it works, Americans by and large are, I don't know if it's a good thing or a bad thing, with TikTok has been fantastic. I think it's a wonderful tool. I always say, if they're stealing my data, what are they going to do? Call my mom? I mean, at the end of the day, the tools are working and they're great. And this is partially a function of unintended consequences of knee-jerk policy when we decided, rather than keep them dependent and coming back to us for all of their tech needs, we were going to sanction them and not give them the raw materials, which they were going to find anyway. And we forced them. Necessity is the mother of invention. We forced them to compete with us when they didn't want to. And now they're eating our lunch so far. So that's where it is, and we'll see what happens. But as owners of Alibaba, we couldn't be happier. So we'll leave it at that. Moving along here, we have some data. This is from Ryan Dietrich. S&P was up first 5 days of 2025. That's a general maximum in the markets going back to 1950. When that happens, the average return is 14.2 versus the average year is 9.5. If the first 5 days is lower, your average return is 1.1. So that bodes pretty well. So he's looking for mid double digits on the basis of that. I'm less sanguine, but I'm open-minded. Our money is going to be made under the surface. I mean, the relative outperformance of what we've seen just in the last handful of days is unprecedented relative to how we're doing relative to the market and everything else. It's just unreal. So Bank of America indicates U.S. household equity net worth up to $1.6 trillion. Here's the bull and bear indicator. Again, not showing signs that you're at the level that you got to puke out everything and sell. We're not at euphoria yet, so that's that. A lot of things to do under the surface. There's a lot of things I wouldn't be buying, by the way, and you know what they are. And by the way, last week's was a lot longer. This is going to be a lot shorter. But that would be the one I would listen to if you just wanted to listen to one for the year and get the roadmap, how we're thinking, and that's already starting to play out. That would be a very useful one to listen to. You can find it on YouTube under Hedge Fund Tips. It's probably the January 23rd, episode 275. Twin Peaks and Treasury yields, these are already coming down. That's the 30-year yield. We already showed you the 10-year yield is backed off 30 basis points already. Value beating growth so far in 2025 by a wide margin. Looks like about 5 or 6%. Twin Peaks in the US dollar. Looks like the dollar peaked out in early January. All the things that we said were very similar and likely to recur from 2016 election to 2017 inauguration, which is why we were so ardent about, if you're coming in, come in now. And many of you took us up on that, and kudos to you. These things are playing. So we said, dollar would it strengthened into after the election. Yields blew out after the election. And then after the inauguration, you start to see dollar back off, yields back off. We're seeing that. And what's starting to happen, emerging markets are starting to outperform. Absolutely was on no one's bingo card except for the amazing, loyal, incredible listeners of Hedge Fund Tips with Tom Hayes. 4-year presidential cycle, 1949 to 2000. Post-election year tends to be pretty good. This is from Jeffrey Hirsch over at the Stock Traders Almanac. He puts out good stuff. So this year is generally a good year, and we've kind of outlined how we think about that. Midterm years tend to get a bit more choppy, so we'll probably be harvesting a lot of profits early next year and creating powder for huge opportunities going into the midterm election, which we're excited about. Here's consumer staple stocks above the 200-day moving average. This is kind of at an extreme here. We like this exposure through the Hormels of the world, through the Diageos of the world, through the things that have been beaten down of late. I think they're going to start to perform. No Twin Peaks in stocks. Okay. Cash bubble, there's still 6.9 trillion in money market funds. So as yields go down and stocks go up, there's going to be more of a chase. It's just human nature. What else do we have here? Home prices near all-time highs relative to rents. So you can see the last few times that you had this extreme of prices relative to rents, prices came down. I do think that's going to be the case. Particularly in Orange County here, where we just bought a house and we did a special situation. I found it incredible. I got it at a discount to what the guy paid in 2019 because he was in a pinch. I just love deals, okay? I told my wife, you want me to sell the bottom in Connecticut and buy the top in Orange County? Are you out of your mind? Have you been watching what I do for a living for the last 25 years? The reason where we are is because I do the opposite of that for a living. Long story short, I found a great situation where my margin of safety is fully intact. And then what's going on in Orange County is very similar to what happened in Orange County in the 90s, early 90s, is you had a ton of Japanese hot money come in trying to get out of Japan, just like you've had a ton of Chinese hot money come in the last few years from China trying to get out of China. And my thesis is generally that you're going to see, as the Chinese economy recovers and stocks start to do well in China, you're not going to see money go back because it's so hard to get money out of China, but you're going to stop seeing it pour out of China. So the marginal buyers in these markets are going to dry up. And once that marginal buyer dries up, you see prices drop pretty quickly. So I do think there's optimism for people looking to buy a house, to just probably be patient, depending on the area you're in. I mean, I think in areas that took longer to recover from the great financial crisis, like Connecticut, I think that they're going to continue to go up, which is why we rented out our houses in Connecticut, because I didn't want to be a seller in the hole. So that's that. But you got to pay attention to these extremes when they're, as my stat friend likes to say, and I'm going to speak to these incredible students on Monday at a high school in Orange County. Shout out to them and to Cork, who invited me. He's a statistics teacher there and does an incredible job for his students. And I'll go have a few words with them as they've requested. So they understand a lot about statistics, and I'm sure they'll be asking me about some of these charts, which is exciting. Here's the US dollar breaking down. We like to see that. 4-year presidential cycle, again from Jeff. You can take a look at that. High yield credit spreads are near record lows, so just keeping an eye on that. Credit markets are still great. I think Cooper Standard will use that window to refinance in the first half of this year. That'll even bring interest costs down further and push out maturities even beyond where they are. So that's another positive thing. They just need a positive quarter, which they're likely to get from the volumes last month. And they'll be off to the races. How much Americans drink? So people have been saying no one's drinking anymore. It runs in cycles, number one. And number two, we've seen these type of peaks and troughs before. As a matter of fact, drinking per capita was much lower in the late 90s than it is today. So this little short-term blip is probably nothing more than that, which is why we like the highest quality businesses in the most dislocated sectors. It's what we've always done. It's why we bought Exxon in the 30s when during COVID, and Wells Fargo at $25. And same thing with the alcohol companies, with Diageo, et cetera. It's the same exact trade. It's maximum pessimism. It's exactly what Templeton was talking about. You don't need to just apply it to the markets and just say, oh, because one or two stocks or seven stocks are super overvalued, therefore everything's overvalued. Look under the surface. There are things that are so pessimistic that are bull market opportunities, and there are things that are too optimistic that are bear market opportunities. And you just have to learn how to distinguish that over time. Okay, we've got, what else do we have here? Earnings are doing well. We'll cover that at the end. I think 12.7% earnings growth was above 9% expectations, so that's good. We're in the seasonal time of year where guidance is softer. That has been the case. They took down earnings from 275 to 272. So you have to keep your eye on that. This is just another way of looking at the midterm. This year tends to be strong. Midterms tend to be a little choppier. So we'll be harvesting profits probably early next year. And probably a lot more than we anticipate, which is going to be exciting. And then we'll put that dry powder to work in the hole when everyone else is puking at the bottom. Consensus expects 10% earnings growth. We did that. Companies have expressed optimism at record high. So you see some mixed, here's the guidance seasonality here. This is interesting. 1/4 of S&P 500 companies are expected to outpace the Magnificent Seven in second half 2025, up from just 8% at the lows in second half 2023. So you're starting to see that rebroadening that you see, and that's looking very healthy for the market. The earnings growth we've covered a million times. Mag 7 earnings are decelerating. Their multiples have not contracted yet, but they're starting to. And the rest of the market, Unmagnificent 493, multiples are accelerating, but their multiples have not expanded yet. They will re-rate. Mag 7 multiples will de-rate. Unmagnificent 493 multiples will re-rate higher. The Baxters of the world, when they finish the sale and the slow growing business is sold, that multiple will re-rate from 12 to probably 16, 17. They'll take their net interest expense down, all those good things. Tech, materials, and communication services are expected to drive best margin expansion in 2025. You still can't give away materials. We've been scooping it up like crazy. The Albemarles of the world, etc. Today was the best performance in consumer staples relative to technology since 2002. Again, pointing back to all the conditions that we said are prime for an outperformance dramatically of value versus growth, small cap versus large, emerging markets versus developed markets. Everything that people can't give away, we are taking advantage of, and it's starting to play out. Total net call volume, buying all the Mag 7 at the top, getting smoked. Rig counts coming down. China industrial profits going up. U.S. manufacturing PMI turning up. We're coming out of the manufacturing depression. How are you taking advantage of that? We know our plays. Breadth expansion awaits macro confirmation from the ISM manufacturing PMI, which all the data is pointing back up. We've been covering that for weeks. Percentage of S&P members above their 50-day moving average. You're seeing this breadth really start to turn around since the inauguration, as we had anticipated. Here's a look at NVIDIA's massive earnings rise and analyst forecast for continued strength. Are these forecasts too upbeat? So they're basically saying that 2 years out, it will be from earnings obscurity to the largest company in the world in 2 years, and never stopping. So $200 billion. So they think it's going to be half. They basically think this company is going to be half of U.S. GDP. So I wouldn't bet on it, ladies and gentlemen. And the wings are beginning to melt. That's all I can tell you. Equity risk premium, people view this as a negative. I view it as a positive. Why? Because this is concentrated and impacted dramatically by the Mag 7. Same thing that happened in 2001, which led to a period of dramatic outperformance of what? Small caps, international, value, all the things that we are loaded into and taking advantage of. Prime book, Magnificent 7, completely overweight. They've been puking out of it. while the retail investors have been buying it. We're seeing how that ends. And then we get a lot of these dip buyers that aren't going to understand how a bear market works in certain stocks that are going to keep buying the dips and keep getting burned. Views of Lula turn negative. When Momo stocks break, they don't recover quickly. That's all I can tell you from years of experience. Views of Lula turn negative. Brazilians worry on taxes and economy. This is very positive. If Lula gets dumped, Brazil is going to be a monster of opportunity, and we will start to take advantage of it now that China's working so well. Dallas Fed manufacturing, this is what we were talking about coming out of the manufacturing depression. So this is DeepSeek numbers, but a day later, Alibaba came out with Quen and smoked all these numbers. So that's all you need to know there. Bank of Japan raises interest rates. We covered this to the highest in 17 years. So when people are talking about DeepSeek definitely has something to do with it, but also pay attention to the carry trade unwind and watch the money flows, and you'll understand why these high flyers are starting to get gut punched. Japan CPI, this is turning up, and you have to consider Japan has no natural resources. That's why it's always been a train wreck, and their birth rate is a train wreck. But so they've got all the input costs. They've got no way to do it. They've been priming the pump. Inflation is going up. They're going to have to continue to raise, which is going to continue to unwind the carry trade. And you're going to watch what happens over the next 6 to 12 to 18 months. Similar things that happened in the periods that we've discussed every single week, and you're seeing play out in real time. Here's the Japanese 2-year government bond yield going parabolic, basically here. Here is the Chinese yuan starting to strengthen. This was a key condition we talked about for Chinese equities to start to take off. We're seeing it all fall into place. Yuan's best week in 2 years, while we had the US dollar's worst week in many years. Healthcare, remember we talked about it on Fox. Coming into the new year, we said no one wants materials, no one wants healthcare. These are the top performers. They're kicking butt in the first month of the year. Broad deflationary impact is intact, so inflation's under control. That should give Fed cover to do the final 1 or 2 cuts, probably back half of the year. Percentage of companies outperforming the S&P 500 since 1990. Haven't seen this again going back to that 2000 period when all the things we talked about took off. Stifel came out and increased their price target to $35 on VF Corp. As we always say, opinion follows trend. And sure enough, Bracken Darrell shot the lights out, and the analysts have to follow. So they've all been conservative. The same thing you'll start to see happen with Baba. Same thing happens over and over. Vornado, whatever it happens to be. We keep seeing this over and over and over. 10-year government bond yield coming down quite a bit. Let's see here. Japanese yen starting to strengthen. Carry trade starting to unwind again. Expectations for global economic boom, highest since April 2022. You also had that early in Trump's term in 17, and that was a good thing. So that's not necessarily bearish. You had it in 2011. So that's kind of a mixed indicator. Current combination of macro conditions has historically been supportive of risk assets. So what you see here is after the first cut, if there's no recession, equity markets tend to do very well in the coming years. We agree. Here's a post from a guy named Jeff Wenninger. This market's leadership is on tenterhooks. So what he's basically showing is that when you have a one-day change, S&P 500 equal weighted index minus the S&P 500, when it gets to this extreme, that tends to be the bottom in the equal weighted basket. And then sure enough, equal weight starts to outperform market weight. Here's an example post of opinion follows trend. These are the same type of people who wanted nothing to do with Alibaba at $58 when we were pounding the table, nothing to do with it at 62, nothing to do with it at 80. Now it's at 103, and they're all saying getting prepared for a blast off sometime in 2025. So, they missed the first 80%, but, other than that, how was the play, Mrs. Lincoln? So let's move on here. Why some Magnificent Seven companies could be earning less in 2050 than today. And in this chart, you'll see the top 10 U.S. companies in Q1 of 2000, trailing 12-month GAAP net income tracked through 2025, rebased to 100 as of Q1 2000. Legend ordered high to low in terms of growth since 2000. And basically what you're seeing here is the companies that were the Magnificent Seven in 2000, a significant portion of them are earning less today than they did at their peak 25 years ago. 4 of the top 10 earners of the S&P 500 at the turn of the century currently earn less than nominal earnings than they did in 2000, according to a review by Jim Reed at Deutsche Bank. Those 4 companies were pegged as IBM, Citigroup, GE, and Intel, while Microsoft's earnings are 10 times what they were in 2000. If it is possible that a couple of the Mag 7 earn less in 2050 than they do today, even if the index is significantly higher, Reed asks, history would say, yes, it is. I would bank on 50% of the Mag 7 will be earning less in 2050 than they are today in nominal terms. I can almost guarantee that. I would make that bet. If you're a sell side banker and you want to sell me a swap on that, I'll load up the truck. So call me, baby. You can put your 6 points embedded in it. We'll be happy to do business. Trump would rather not put tariffs on China, maintains threat. Japan core inflation climbs to a 16-month high, boosting case for rate hikes. Yuan gains as Trump dials back tariff threats. Trump says he'll demand interest rates drop, urges OPEC to cut oil prices in Davos speech. Trump says he knows interest rates better than Fed Chief Powell, so there will be a push-pull there. He'll get 1 or 2 cuts out of him, but Powell's like, hey, legacy baby, I'm riding this baby out until early next year when I step down on my own terms. We'll see. Never count Trump out. If he wants something, he's going to get it. Beijing tells insurers to buy more Chinese stocks. China's new rules add $138 billion into the market. Japan raises interest rates to highest level since 2008. That is a carry trade unwind, ladies and gentlemen. This was the last carry trade unwind. So pay attention. Burberry sees positive signs as turnaround plan continues. I think a lot of these luxury brands are going to start to see their day now that China's back. That also includes Nike, but certainly Canada Goose. Vans is already seeing, VF Corp is already seeing it in spades. And we'll see many more to come. Beijing tells insurers to buy more Chinese stocks. U.S. bond stocks at most expensive relative to bonds since .com era. These are all the things that we keep talking about. This is equity risk premium, and they keep talking about it as stocks. It's the Mag 7 pushing, so what's going to get hurt is what's pushing it. I mean, Buffett had monster returns in 2000, 2001, 2002, 2003, 2004, when everyone else was getting smoked. Because while everyone was buying Global Crossing and Enron and Cisco, he was buying, Coca-Cola and boring stocks that no one wanted, and he just dramatically outperformed. He was ahead of the curve. He skated to where the puck was going, not where it was, while they were writing articles about him, wondering if, quote-unquote, Buffett has lost his touch. He was getting wealthier and wealthier. Dollar post worst week in 14 months as tariff risks aside. Diageo weighs options for Guinness in portfolio review. They're selling the African division, which is good. They're taking some actions, culling some stuff. We covered that one in one of the recent weekly articles. Will the Chinese consumer finally start spending? Good question. My answer is probably different than Bloomberg's. Mid-cap stocks have been in the shadows. Why 2025 could be their year. We were talking about that all fourth quarter. You guys are already positioned for it. Dollar falls after Donald Trump hints at softer stance on China tariffs. So 60% on day one was not in the cards. We'll see how it goes. Investors bet Trump will make Europe investable again. We've seen the biggest inflows into European stocks starting to perform. International is going to perform. We've got some exposure in Europe through GXO as our big play. We think that's going to be a home run. PBOC injects record liquidity via new tool as yuan limits easing. China stock set for $236 billion influx from state-owned investors. That's from UBS. China's great coupon handout from far from enough to spur consumption. So this is a journalist who is just looking at one-off. What they're neglecting to take into account is the fact that these one-offs have been going on for 12 months and they're all starting to collect, and the beach ball is getting ready and it's starting to explode out of the water. It's been held underneath the water for too long, and now it's off to the races. Nvidia slashes nearly $600 billion in market value. What's driving the panic? Okay. Estee Lauder reviews brands amid management change. Beauty Group is working with Evercore to review portfolio, looking to improve performance under new CEO. Look, all you need to know from this article is very simple. The Lauder family owns 38% of Estee Lauder's total common stock and about 86% of the voting power. They're going to get this right. If you remember, Walmart had periods like this, and the Walmart family stepped in, got a new CEO, made changes, invested in online massively. The market said, oh, they're crazy, they're blowing all their profits, and now they've been dominating. The same exact thing is going to happen with Estee Lauder. They've been through this in the past. They sell brands, they buy brands. Same as VF Corp. They've been trading brands for over 100 years. They know how to do it. Young Americans are drinking less, but can it last? And we kind of covered that with the other chart. The answer is no. People are going to drink, and it goes in cycles. And here, even so, they're picking up some market share with these low and no alcohol beverage markets. Look, all of that's a good thing, but in the scheme of history, the way these quality stocks are priced relative to the reality of the short-term softness in the underlying business is such a big divergence. That's how you make money. You know, if a stock is down 50, 60, 70% and it's the best in class, and the overall industry is down 2.5%, that's an opportunity, because even if the pie gets smaller, it's just going to put the strongest player in a position to gobble up more of the competition and take advantage. So even if the pie went 75% smaller and the number one player controls 100% of the, or 95% of the market, that's a win. That's not going to be the case here, but it's just a way to think about it. Another mental model to keep in the back of your head. Beijing unveils $7.2 billion injection of insurer capital for stocks. AI-fueled stock rally dealt $1 trillion blow by Chinese upstart. Also, a lot of Japanese carry trade has to do. Chinese boost index investments in latest bid to revive markets. Building products distributor QXO launches hostile bid for Beacon. This is not Brad Jacobs' MO to do hostile. He's a very cooperative kind of acquirer and activist. He is paying up for Beacon. I don't like that, but he sees something that I don't see, and I'm going to trust his judgment based on the fact that he's built a handful of multi-billion-dollar companies from scratch and made shareholders billions upon billions of dollars over many decades, whether United Rentals, whether XPO, whether Waste Connections, you name it, he's done it. He knows how to do it, and he just needs to get in the game. So he'll wind up having to pay more. I think he's going to get this done. I wouldn't lose sleep if he didn't. I know the market will be disappointed in the short term, and we can build a bigger position, but I think he'll get it done. I don't think he'll get an enormous pop because he's going to overpay for it, but he's talking about the benefit of what he's always done in his roll-ups is he's brought technology into boring industries that he can buy at a reasonable price, and then he rolls up a fragmented industry. So he's paying up for this public platform, and then he'll roll up a ton of fragmented private businesses at much lower multiples. So we'll get it back. He just needs a platform to play, and I have full confidence. But this is uncharacteristic, but probably necessary at this point. And my guess is they've got 2 or 3 other options if this one doesn't work out for some reason. Boeing's rosy outlook negates the need for fire sale. Don't know what that is. Where do we? Oh, U.S. manufacturers show signs of recovery from 2-year slump. GM stock falls as carmaker signals that tariffs may impact its outlook. Yeah, and it's completely unknown. But their numbers were better than expected. Their units are better than expected. And I think that is going to continue. You cannot invest on the basis of what may or may not happen in terms of policy. It's going to take you out of too many stocks. At the end of the day, if the worst case happens with tariffs, people are still going to need cars, with the average car on the road being 13.5 years. Short rates are still trending down, which helps the consumer. The difference is going to be like houses. Not everyone needs a 6,000 square foot starter home. So they're building a lot more 2,000 and 1,500 square foot homes. And more people are moving from big SUVs to more affordable sedans. And I think that's what you're going to see. And units are going to go up. They just might be smaller units, but it doesn't matter from a Cooper Standard perspective. It does matter from a margin perspective for GM. It does not matter from a margin perspective for Cooper Standard. Billionaire Castell to acquire Diageo's unit and expand in Ghana. So he will get Ghana Guinness. Boeing CEO, don't expect a major restructuring, possibly a pruning. So he's showing signs of confidence. Also says company reaching 737 key milestone this year. Alibaba touts new AI model as it says rivals DeepSeek, OpenAI, and Meta's top offerings. It doesn't just rival, it exceeds according to the data. 10-year treasury yield slides after weaker than expected GDP. Baba launches new AI model that outperforms DeepSeek, blah, blah, blah. Intel's fourth quarter sales beat estimates during turnaround. There's nothing to do with this story until they announce a new CEO or we figure out if they're in play. But I think the next catalyst is a new CEO. Nice to see that they did a little better than expected. Shows progress in the face of another decline. Look, number one, co-CEOs never work. Number two, you just need to get a new big name in there, and the game will be on. It's Plains and Parka's stock market and sentiment results. So we covered a lot of this. What I want to cover... this was interesting. Canada Goose got the green light from the Ontario Securities Commission to buy back up to 10% of its public float, doubling its U.S. share repurchase capacity. In other words, our slice of pie is about to get 10% bigger without putting up any additional capital, which is exciting. That's why the stock is starting to move. And I'm sure they wouldn't be in the market buying a ton of stock if sales were going to be weak. In case you haven't noticed, it's been a cold winter, and Asia is back. So I would expect better numbers than one would anticipate moving forward, in which case the buybacks will be very meaningful. Boeing update. So what I'd rather do, you can read through the article of the week if you haven't already. We're going to listen to the CEO himself, Kelly Ortberg, on CNBC right after earnings.
But Boeing as well, company reporting its biggest annual loss since 2020. And our Phil LeBeau is here this morning with the CEO. Hey, Phil.
Hey, Carl. Kelly Ortberg, thank you for joining us this morning. Look, we know what 2024 was, and you do that going into this job. Yeah. As you look at 2025, I can tell that you see some reasons for optimism here.
Yeah, I really do. Despite the challenging fourth quarter, we are making some significant progress. You know, we had a great capital raise, so the balance sheet is solid for the next year, and we're starting to see really good progress as we ramp production back up on the 737, and the MAX production rate is critically important to the recovery of the program of the company.
Are you seeing what you need to see so far to say, yeah, I like where we're headed in terms of getting ultimately to 38 per month at some point this year?
Yeah, we're actually a little ahead of where I expected. You know, coming out of the strike, we slowed down intentionally, rebalanced the production line, and I think that's paying big dividends for us right now. We'll probably deliver in the upper 30s on 737 MAXs in January. Now, we had a lot of airplanes in inventory, so we're flushing through that inventory. But so far, so good. And what I look at is less about the deliveries and more about the key performance indicators that the FAA is using to determine whether we're able to move beyond 38 a month. And those indicators are looking good. And we're going to stay focused on making sure we're disciplined as we build these airplanes and ramp back up.
All of this is happening as we have a new president in office. Two questions here. One, have you talked with President Trump? And two, Elon Musk and Doge is one of his big plans. and driving greater efficiency. I know you've talked with Elon Musk. You've had him down to your facility where you're building the new Air Force One. What is your perspective in terms of what President Trump will do during his administration?
Well, first of all, I mean, he's keenly focused on American jobs, and he knows that the aviation industry is critically important to American jobs. And we build these airplanes in the U.S. and we export them throughout the world. So I think the administration is going to be very supportive of not just Boeing, but the overall aerospace industry. And yeah, we've been engaged with Elon on looking particularly at the VC-25B program, at looking at that program and seeing are there areas that we can make changes to that program, eliminate cost, eliminate schedule. The president wants the airplane sooner, and so we're working with Elon and their team to figure out what can we do to pull up the schedule of that aircraft.
Have the interactions so far been what you would call constructive?
Oh, yeah, absolutely. I mean, they sincerely are looking at things that are in the contract or in the process that are slowing us down, that aren't providing value. And we're engaging with the Doge team to see if we can't find that right mix of requirements that need to come out and get out of our way so that we can be more efficient and deliver a better product.
Kelly, Jim's got a question for you. Jim, go ahead.
Thank you, Phil. Kelly, thank you for coming on. I'm wondering why the second half is when things get better. I would expect that the second quarter is. The reason I mention that is because I don't want people to buy the stock knowing the second quarter is awful. I mean, how do we know that things are going to get better in the third quarter if the second quarter is not good?
Well, Jim, we haven't forecast a bad second quarter. What we've said is that the first half will be a usage of cash, and then we'll turn to a cash positive in the second half of the year. But it's all determinant on the 737 MAX production rates. And I'm not going to put a date on when we need to get to rate 38 and get approval for the FAA to go beyond. It's more important that we do this right. We have a stable production system. We get through that. And I expect by the second half of the year, we'll have that approval and we'll be moving to a higher production rate. So that's really what's driving the first half, second half profile.
You've got the labor agreement. I know you're hands-on now. It looks like that you've got a lot of good people. How many can you do max? How many? Not the max, but how many can you make per month? Because I'm trying to figure out how to model what the second half could be.
Well, we're planning to be at about 38 a month for the balance of this year, ramping up and we'll go in 5-step increments every 6 months after that. So that gives you a feel for how to model the rate increases. On 787, we're at 5 a month rate, moving to 7 a month rate, and we'll do that when our performance indicators say the production system is stable, and hopefully that's in the next quarter or so.
Kelly, when you look at your defense and space portfolio, look, it's been a mess. You continue to lose money with some of these programs, especially the fixed price programs, contracts that have just they've not been good contracts. Have you talked with the incoming or the new defense secretary, I guess, and do you expect that to change in terms of how these contracts are bid out? Because clearly it has not worked over the last several years.
Well, so first of all, I haven't spoke to the new SecDef, but I certainly hope to, as he just, was just confirmed. I don't think that we're going to change our approach to these programs. As you know, we've learned a lot about these fixed price development programs, and we're just not going to enter into the wrong contracts. Fixed price has its place, but it isn't in high-risk development areas. I think cost plus is more appropriate. I don't think that's going to significantly change, but we'll work with the administration as they look at what they want to do for contracting going forward.
You have some divisions that you are currently considering or have said, look, we will take some bids on some of our divisions or businesses, subsidiaries. How many of those do you expect those transactions to take place this year?
Well, a few. We've got a couple in advanced stages that we're looking at. I'm through my portfolio review. Don't think of this as major structural redesign of the corporation, but I do think there's places that we can streamline, and so we'll be actioning those here in the next 6 months to a year.
When might we expect you to name a new president, CEO of Space and Defense? Is that a first half hire, or do you think it may take a little longer?
I don't have a fixed time on that, Phil. It depends on the availability, the right person to lead that. And I've got an interim CEO who's doing a great job right now. So I'm not in a hurry to make a bad decision. We'll take that when the time's right.
And we're back. And then we had VF Corp, and Bracken Darrell did an incredible job. You can go through these key points on your own. I think his interview on CNBC after earnings told the whole story. And, I was pretty optimistic, kind of thinking that this is a story that could easily go to $40, $50. If you remember, listen, Liz, this is going to be an incredible turnaround. And she's like, she looked at me like I had three heads. She's like, John, what do you think? Kind of like, this kid is crazy. And sure enough, it's a double now and probably a lot more. So I figured it would be a triple. But listening to him and kind of his long-term mindset, as these numbers continue to improve and the free cash flow continues to improve, he's going to be buying in stock. I think this is going to be a lot more than that. And we'll just see how the fundamentals go.
Take that when the time's right.
But there you go. Congratulations on hanging in, guys. You deserve it. And just the beginning. So on to the next. Sentiment is neutral. Managers are starting to get some more exposure. REIT earnings, top 30 weights, are up 17 bips. Utilities, top 30 weights, revisions up 40 bips in the last 60 days. And on here is the earnings growth rate with 16% of the S&P reported is 12.7%. That's exceeding estimates by about 3.7%. So that's positive. Guidance, though, has come in a little bit, which is normal seasonally, so we'll keep an eye on that. So with that said, we're going to move on to the Ask Me Anything questions. If you like the Ask Me Anything questions, hang out with us for a little bit. If you don't, thanks for tuning in this week. We'll be back next week. So here's the first question from JP. Hi, Tom. Thank you for all that you share. You create more value than you will ever know. What is your opinion on UPS? I like that they're getting rid of less profitable work, focus on higher margin. Reminds me of PayPal. That's a good question. I kind of started to sniff that one out, but I continue to think it's a little bit early. You don't fire Amazon and get away with it right away. That's all I can say. I think that this one is a wait and see. I'd probably put an alert below $100. If it breaks $100, I'm going to start to look at it aggressively. But right here, I think it's in flux. Michael, I see a lot more Amazon trucks than I do UPS trucks. That's for damn sure. Michael Ozarek. Tom, thank you for your weekly lessons. Could you lay your thoughts on Kohl's Corporation? Will the new CEO from Walmart, Ashley Buchanan, redefine back to middle-class shoppers currently closing unproductive stores and cutting workforce, probably cut dividend? Is that debt burden untenable? Thanks. We've looked at this one a few times, and we've continued to say no. I think that's going to be the theme. I will say, driving around the other day, I saw that they had these stores that were Kohl's plus Sephora, and Sephora is on fire. So that might get more feet into the door of younger people. The store in the store concept never worked. Just see JCPenney. But I just can't get excited about this one. So I'm going to pass. The retailing business is very, very hard unless you're specialized like in advanced auto parts, and it's still hard. I think I think this is a good trade. I think it's going to be a long-term slog. I just don't like the business. I mean, the Kmarts of the world, it's very, very tough to turn around that model. I'd be more inclined to look at Target at these levels, but I'm not. Okay, Patrick Bunzel is asking about NEP. I don't know what NEP is. Oh, Nexera Energy Partners. This is probably a don't touch. What is XPLR? Explore resources. Neither of these are for me, but thank you for tuning in. David Pang. Hey, Tom. Been listening to you for about a year. I've come to really enjoy your insights. If you're ever in Columbus, love to meet and become a client. Okay. Here's the AMA. Okay, MetaFast. No, we've covered that. No, thank you. Hard pass. Thanks for the question. And yeah, love to meet in person, or when you're in New York or Orange County, look me up. Tom, thank you for all that you share. You create. Oh, we did this. Don't resend questions, guys. All right. Sam G. Love all the work you do for us. Thank you. Regarding CPS, wanting to get your take on the impact of autonomous robotaxi to earnings valuation over the next 2 to 5 years. Seems like autonomous robotaxi is getting a lot more attention or hype, whether it's warranted or not. Wonder if it's impacting multiples. Logic would imply less cars will be needed long term. Yeah, you're overthinking. Number one, that stuff takes longer than you expect. And number two, we're not going to be in this 2 or 3 years. I mean, maybe we'll be here 3 years from now, but we're not going to be here 5 years from now. And it's probably going to take a lot longer than that to have any dent, assuming everything goes according to plan with autonomous. And I'm not convinced that it's going to be that many. It'll be less cars, but and then you got to think about the global. You're just getting caught up in the headline mix, and that's not what we're focused on. Tom, admire your drive, dedication, and priceless work you put in week after week. Thank you. This is from Goran Stojcic. Thank you. Would you agree that Intel is the least discussed, totally ignored potential winner of DeepSeek-induced AI terminal? Reason being that open source AI models are run locally on laptops and PCs, which will speed up their adoption and proliferation. Intel dominates that space, powering 9 out of 10 best-selling models across leading OEMs. Well, I will say this. The beauty of DeepSeek and Co. is that they can be run on inferior chips, and Intel is the leader in inferior chips. So with that said, I do think it's going to be a positive. I also agree with part of your thesis on that, but that's not why we're in the stock. That is a benefiting tailwind that will support our original thesis, and we're on the exact same page with you, and we love all the weakness, and we continue to take advantage. Okay, Don L. Thoughts on MRX? Sold to you, not interested. Let's see what it is. Shiny object. Don, welcome to the podcast. I'm assuming you are a new viewer, and we are super happy to have you on board. We always, look, there are many paths to the top of the mountain. Shiny objects are not one that we take, but they are a way for other people to get to the top of the mountain if they should so choose. We just like more predictability. But let's just see what this does before we... Financial services platform, market access, commodity, no, thank you. Hard pass. Griffin Brown, reading The Intelligent Investor now. Have you ever read Security Analysis by Ben Graham? Yes, multiple times. Do you recommend I read that or any other book for financial statement analysis? Start with that, and then just start reading read all the CFA books, start reading a lot of annual reports, and take it from there. Thank you for listening. Jacob Saxtoff. Do you think that the DeepSeek news could be the catalyst for NVIDIA to experience the same as Novo Nordisk did, where the stock starts to tumble? I think I intentionally am not playing in that space because that's a better than a coin flip risk. Bill Vaughn, does there become a factor or systematic aspect of turnaround investing? I know it's your framework to buy at the bottom when sentiment is at a trough, but does this not increase your portfolio risk given these scenarios may be correlated with rates, capital market strength? This is why I'll never have any real competition, this is how most people think. I view each business on a discrete basis. I'm cognizant of credit conditions because when we bought Cooper Standard at $5.10, credit markets were closed. So that is what creates the opportunity if you know what you're doing and you know what the asset coverage is and you do proper solvency risk. So no, and the second answer to your question, which is a good question, Bill, and thank you for sending it in, is it's why you don't own one stock. You know, the second question we always ask when we're getting into investment, if this goes to zero, if there's something I don't know that I don't know, will they take me out on a stretcher? And the answer must be no. So I'm taking 8 to 12 discrete risks on the basis of some are turnarounds, a good portion are turnarounds, but these are durable businesses that have operated through many cycles, and there's some catalyst in play. So it depends on the sector, the company, the competition, where they are in the cycle, what has caused the downturn, what is the bear thesis, what are they seeing that we can adopt and still say that it's overshot, and then starting the analysis from that framework. But no, everyone thinks there's going to be a cookie cutter magic formula that, they can press a button and become Warren Buffett. Warren Buffett became Warren Buffett over 60 years of experience, and he made a lot of mistakes in the beginning. Go read his early letters. And the only way you can get to that level, or anywhere half as good as that level, no one will ever be Warren Buffett, is through experience. And that's the quick, and you got to love the game, because if you're doing this for money, you will fail. Go run a business where you get paid for massive action and you'll make a fortune. And then you give it to the handful of people in the world that can do a really good job buying these type of businesses and buying them right, and having the ice in their veins and doing it with low leverage and all the conditions that are critical. And you're buying their experience, you're buying decades of their life for pennies on the dollar to do it for you while you're at the beach. And that's what the smart people that invest with me do. They're like, I'm a centimillionaire, I'm a billionaire, I'm going to lay it off to Tom and let him worry about it all day. And if he does well, I'll give him more. And if he does poorly, I'll shut it off. And the bottom line is we don't lose clients. That's everything you need to know. So that's how I put it that way. But good question. On to the next. Joe Cook. Hey, TT, turnaround Tom, great energy, thank you. I know you delay telling non-clients when you get into a position. Will you be telling your non-clients? We will not. We discuss companies on a weekly basis that we think are interesting. Most of the time we own. I would never listen to someone talking about a stock if they didn't have skin in the game. Like, it's like someone trying to sell you an investment or a partnership. It's like, okay, well, how much do you have invested? Oh, I have nothing, but you should invest. It's like, okay, salesman, thank you very much. On to the next. I will only listen to people who have skin in the game, and then I got to make my own determinations if they're correct. But number one, this opinion, not advice. Go to hedgefundtips.com. Terms. Consult your financial advisor. Most of these are not appropriate for any of you. You should be talking to your financial advisor. We deal exclusively with accredited investors and qualified institutions, qualified clients, for educational purposes, etc. So we have no obligation to tell you when we're getting in, when we're getting out. That is for the benefit of our clients. That is our sole responsibility is to our clients. But we do let people know when we get out. And, that's that. But, our average holding period is, 12 to 48 months. So it's not like we're talking about a stock and selling it, the next week. We may be selling in 2 years or 3 years or 4 years. We're just saying this is our framework. And a lot of times we'll put out a name that we've got invested in and it goes down and we buy more, so about it at a better price than we know about it, but we average down and then we make a lot of money on the upside. So it's, that's the way it goes. Matt Del Priori, thanks for everything you do. What are your thoughts on SoFi? No, not for me. Covered a million times. I hope a lot of people make money on it on their own. I've never had success investing in a company that was run by a former investment banker. I will say Anthony Noto might be the exception. He seems like a super quality guy, ex-military veteran, etc. But I'm going to still stick with that rule. We'll just leave it at that. David Mullinex, love your work. Been watching you for a few months now. What do you think of Constellation Brands? I know you like Diageo. I think they'll all work, but I think Diageo's got a better look at premiumization, which is the trend that's going to be able to weather any storms. Constellation doesn't have that moat, but it's a pretty good business and will benefit from the same thesis, same as Brown-Forman, but I like Diageo better here. A lot better. Cole, I would not buy Constellation, so that's my answer to you. Cole Fleischman, is this pullback not the yen carry trade unwind? All I see on my feeds are DeepSeek, but now Bank of Japan. The rate hikes, what do you think? Yeah, you guys know that from listening to me for weeks. That's part of it. They both played a role, but that was the one thing that no one was talking about. Sebastian Penna, thoughts on PCG? And QXO. The problem with QXO is you're paying 2x the cash for a SPAC. So you're basically given $6 for nothing other than Brad Jacobs' multi-decade track record of creating billions of dollars of wealth for his shareholders in multiple businesses. So the problem with QXO, Sebastian, is if he screws up, you're going to lose half your money, and they're going to liquidate for $6 or $7, and that's what it is. That's a risk I'm willing to take. They won't take me out on a stretcher. All the other positions are crushing it. So, but I think that's a very low probability because Brad Jacobs is not a quitter, and he's going to get something done, and he's going to get a platform, and 10 years out, you're going to have an 8 to 10 bagger and a nice IRR. So, so that's that. Thoughts on PCG? This is hairy. This is California. It's a turnaround. We actually did ride this up. We bought this in the hole during some years back, and it wasn't a huge position, and it made a nice move, but I think we sold out at like $16 or something. It went up to 21. Now it's back to 16. This is California based. I'm going to just be a pass on that. There are a lot of reasons why it could work, which is why we got involved, but it's not something I really want to do right now. Okay. Patrick, same answer as the previous question about other books and things to read. And that's it. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.